So I was 27 when I first started out investing, and since then I have built a 6-figure plus portfolio in my stocks and shares ISA, but I only started depositing into a personal pension this year at the age of 31. So in this video, I'm going to talk about, prioritizing your stocks and shares ISA or your private pension in order to retire with a more comfortable life. Now, like I said, I have built a 6-figure plus stocks and shares ISA portfolio. So this one's on Trading 212. As you can see, the current balance is £110,000. Now, since I started investing, I was always prioritizing the stocks and shares ISA. And my reasons for that was that the stocks and shares ISA is completely tax-free upon withdrawal, and you can access it at any time in your life. So even if you, for whatever reason, let's say you go to the doctors and they say you only have, a year left, you can access your stocks and shares ISA, no problem. If you want to change your mind and spend it on a house anyway, you are more than free to do that. However, with a self-invested personal pension, of course, you can only access it around the age of 60. I'm going to say around the age of 60 because, of course, it can change. Currently, it's around 58, I believe. Now, like I said, the stocks and shares ISA is a great tool for early retirement or retirement on your own timeline. No one can really dictate when and how you can use it. Now, let's say for me personally, if I want to retire early, let's say at the age of 50, which for me is in 19 years, I currently have £110,000 in my Trading 212 stocks and shares ISA. Let's say I get an average return of 8% per year. Now, let's say I don't deposit a single more penny into my Trading 212 stocks and shares ISA. Let's see what I could potentially have in 19 years. Make sure all the numbers are right. £110,000, 8% annual yield, 19 years, let's go. As you can see, even if I don't add a single other penny into my Trading 212 stocks and shares ISA, in 19 years, it could be worth £500,000. Now, using the 4% rule, you can't always guarantee that will work, but let's say we do that, that is about £2,000 per month that I can take out and not have my portfolio go down into smithereens. Now, that money is completely tax-free as opposed to a pension with the same size, let's say £500,000. Of course, you can take out your 25% lump sum. Most of the time, you might not even want to take out 25% as that could be quite a large amount. But even with an income of £2,000 per month, you're going to be paying around 20% tax on that, providing you don't have any further taxable income. Now, that's not to say that I will not be investing further into a stocks and shares ISA. I've had the idea of just separating my different stocks and shares ISA. So the Trading 212 I'm going to keep for the long term, and then any more I will be using to, save up for a housing deposit. I've been intending to make, separate videos for my different providers, but this is just one. For example, I'm trying to, use my allowance across more than one ISA this year. And here is another stocks and shares ISA. I haven't completely maxed out my stocks and shares ISA allowance this year, but I'm keeping my options open. In addition to that, I still have cash in general investment accounts or investments. So I am still investing outside of an ISA because we still get those really important allowances, for example, £3,000 capital gains. Additionally, I do have a lot of capital losses from previous years and this year that I can use to offset. So tax efficient wise, it makes sense for me to be investing outside of an ISA for now. If you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to click the link in the description box down below. Alternatively, if you've already signed up to Trading 212 in the past 10 days but haven't received a free fractional share, all you have to do is to click the 3 horizontal line menu over here. Scroll all the way down until you see the section use promo code. And in this section, just use my code JUBAIR and you should receive a free fractional share. Now, like I said, this was the first year that I ever contributed to a pension, private or otherwise. I've always opted out for pensions as I didn't completely understand the benefit of, investing into something that you have access to so late. But as my income grew, it made more and more sense to actually, sacrifice some of my earnings towards a pension because there are actually a lot of tax advantages into investing within a pension. Now, with a pension, when you are drawing down, you are paying tax, in your normal income bands, which will almost definitely in 20 years be different from the income tax bands, we have now. So there's no point of me actually talking about it. But anyway, as you can see, I deposited £10,000 and I got a 20% tax relief from the government as a payment, of £2,500. Now, currently, this is all in cash just in case the markets take a dip. But of course, it will be invested soon as it doesn't make make much sense just keeping it as cash. So the reason why I deposited into a SIPP was that last year I was operating as a sole trader and my income was over £100,000. And now for any pound earned over £100,000, you do lose your personal allowance. And by depositing into a pension, you can reduce the amount of taxable income. You do get a relief of 20%, but if you are a higher or additional rate taxpayer, you can claim back more via your self-assessment. So opposed to a stocks and shares ISA, putting money within a pension is a lot easier because you get a lot of tax relief. However, taking money out on the other end is going to be a taxable event. But if you think about it, you have a lot of time for your money to compound, so the benefits can outweigh the disadvantages. Now, you can have multiple SIPPs or you can put them all together. I am definitely looking to open a new SIPP, a self-invested personal pension. This is because now I am operating as a limited company, and through a limited company, you can actually contribute to a pension. Now, unfortunately, the ones that I probably would recommend because of their low fees do not allow contributions through a company. Therefore, I am looking for a SIPP from providers such as Hargreaves Lansdown. Now, the thing about pensions is that pension providers can often charge very high fees as opposed to stocks and shares ISA providers who pretty much have almost zero fees. Other fees may apply like ETF fees. Now, for example, currently with Hargreaves Lansdown, you are paying a standing charge of 0.45% if your investment value is under £250,000. Now, 0.45% in fees can easily rack up, especially throughout the years, and that can really eat away from the value of your pension when you're retiring. Now, in addition to that, every time you buy a stock, you're going to be paying a dealing charge, which is around, 10 to 12 pounds, which if you're investing every month can really eat into your performance over the long term. Now, there are other providers, for example, AJ Bell, which I am looking at. Now, they still do have ongoing fees. For example, under £250,000 in terms of funds, you're paying a 0.25% charge. Now, it is worth mentioning with Hargreaves Lansdown and AJ Bell, if you have a large pension, then the charge does go away. So it does incentivize, keeping all your pension in that one provider so that you can reduce the fees as your pension pot grows. Now, like I said, there are dealing charges. With Hargreaves Lansdown, it is a lot more expensive. But for example, with AJ Bell, every time you buy a share, you are paying £5. However, with Hargreaves Lansdown, for example, there is an option to direct debit straight into your SIPP, which you can reduce these dealing charges. However, if you are operating as a company, you can't really direct debit because oftentimes it's very difficult to know how much profit you have at the end of the month. Now, as you know, per tax year, you can contribute a maximum of £20,000 throughout all of your ISAs. So this includes stocks and shares ISA, lifetime ISA, cash ISA, and the list goes on. Now, I know most people in the country will be very hard pressed to maximize this amount, max out their £20,000 ISA allowance. Now, for a lot of people, it just makes sense to just contribute to a stocks and shares ISA. However, this money is already taxed. So the money you put into your stocks and shares ISA, you've already been taxed at that, maybe at 20%, maybe at 40%, maybe even higher. However, with a pension, you get a basic rate tax relief straight away. So that tax you would have had to pay, you no longer have to pay, and that gets added to your contributions inside your pension. So on the way in, it is a lot easier to fill up a pension. Now, like I said, basic rate taxpayers get 20%, and via a self-assessment tax form or consulting your accountant, you can get more tax relief off of your tax whenever your taxes are due. So on the Hargreaves Lansdown website, there is a nice calculator. For example, let's say you want to contribute £2,000 into your SIPP and you earn a taxable income of £35,000. Let's press calculate. So as you can see, for a £2,000 contribution, you pay £1,600 and the government adds £400 as this is a 20% tax relief. Now, this makes it incredibly easy to fill up your SIPP, and if you are a higher rate taxpayer, let's say you earn over £100,000, instead of paying a very high rate of tax, you can reduce your taxable income by depositing within a SIPP. Now, at the end of the day, it's going to come up to you completely to decide what you should prioritize, a stocks and shares ISA or a SIPP. For me personally, I am very glad that I prioritized a stocks and shares ISA when I was younger, and now I'm focusing more on filling up a SIPP. The maximum amount per year that you can fill up a SIPP is either £60,000, or if you earn less than that, that's the maximum amount that you can deposit. There is a way of actually claiming the past 3 years of SIPP allowances if you haven't used it, and using that to fill up your SIPP. Now, obviously, there are more benefits of a pension that I haven't mentioned. For example, employers' contributions. There are many employers out there that have very good pension schemes that will, boost your pension by a set amount, and you should really look into taking advantage advantage of that. I'm not going to go into the specifics of that, but of course, if you have a good employer like that, take full advantage of it. But when it comes down to transferring your pension, there could be certain fees or terms and conditions in the way. So, that's a video for another day. So make sure to check out some of my other videos, and I'll see you in the next video.